Welcome to Investing with IBD, sponsored by North Coast. It's October 6th, 2021. And on today's show, of course, we have Justin Nielsen, myself, your host, and Arusha Pires, O'Neill Global Advisors Portfolio Manager, joining us as he does every week. Thanks for being here, Arusha.
Hey, great to be here, Justin. I'm glad you brought yourself on too.
Yes, I usually do. I try to. Yeah, thanks for noticing. Yes, we actually just came off of a great Founders Club event that we had up in Napa. We both survived that. It was a lot of fun seeing people in person. And I should also mention that on the show today, we also have Nina Deka, who will be coming on a little bit later. She's returning to the show. I actually listened to your podcast when you did this with Nina Arusha. It was one of the ones I listened to. Every now and then I did.
Thanks for the support.
Right? But she's a senior analyst at ROBO Global, and gosh, I mean, it's just so interesting, all of the things that are happening in healthcare technology. So we'll be bringing her on in a little bit. But first, Arusha, how about you and I talk a little bit about the market? Then we'll bring Nina on, get into the healthcare trends that are going on, and I'm sure Nina will have a few stocks for us. But this market has certainly been pulling back. We've, those 15,000 level, 15,400 level that we saw just a few weeks ago, seems like 14,000 is coming a little bit closer, and that's getting a little bit further in the rearview mirror. Now we haven't gotten down to the 200-day moving average line, but it does seem like, at least on the NASDAQ composite and the S&P 500, that we are starting to live below that 50-day line a little bit. What do you think?
Yeah, we're having something, potentially could be having something called a correction. It's been a while since we've had that.
So for those of you that haven't been investing for so long, yes, a correction is, what is a correction, Arusha?
A correction, is a lot of times a correction can just be an intermediate pullback too, yeah. 8 to 12% off the highs. The markets take a couple of months off, and they're tough if you are heavily invested on margin. You can give a lot back at that point, but they're also tremendous opportunities if you're protecting yourself and being patient and letting stocks settle down again before starting to build those positions.
Yeah. Now, there's two things that I always think of. Number one, and this partially just comes from the experience that I had in 2000. Look, not to brag here, but I got out in 2000 so well. But man, did I mess it up in 2001 and 2002, gave away a lot of profits just trying to get back in, trying to make money when the market was clearly signaling that there wasn't money to be made, or at least very easily. So you have to just be very careful in that environment. Mark Minervini, last week, he was our guest, and he was talking about sit-out power. It doesn't mean that you have to be completely in cash, but I think reducing your exposure considerably makes sense. And that's what we've been, telling people. That's what we've been doing. A lot of us have been talking about that on IBD Live. So are you completely out, Arusha, or are you still dabbling a little bit here and there?
I have very little, just some pilot positions, and it's just very simple. A number of the stocks I had, and they were more high multiple technology related stocks, they got hit. So it forced me out. So now I'm trying to develop that sit out power, just letting stocks set up. And I know that there's going to be another big opportunity, so I don't want to drift too far away.
Right.
But we are in a market in correction. We've collected a lot of distribution days. And so you just want to respect that, because you never know how far it can drop. Maybe we're hit the bottom right now. We don't know. But it could go lower, and so you want to let the market prove itself again.
Yeah, there's all those sayings about trying to catch a falling knife and all of those things. And again, just to put in perspective, look, 8 to 12%, that is normal. You usually will get at least one of those every year. For a lot of people, that's something that they haven't seen in their investing career, but this is normal. And even better, it sets up a lot of opportunities. This is where the bases get formed. This is where the new stocks start coming out and looking spectacular. The relative strength lines are holding up well, and it just gives you a whole new reset almost to another potential uptrend. So optimism overall. the big takeaway here on the market is, be careful out there. This isn't the time to go aggressive. This is really just wait and let the market tell you when it's time. Certainly read some of the stuff that we have on follow through days. That's usually the signal that we look for when the market turn is happening. But more than anything, be careful out there. So with that said, let's go ahead and bring Nina on. And Nina, so glad you could join us again. I found your last podcast that you were on the show just absolutely fascinating. Bill Studebaker, also of ROBO Global, the president of ROBO Global, he was on. He was one of our first guests when Arusha was taking a step back from the hosting position. And I felt like it was, my days of reading Robert Heinlein and Isaac Asimov all over again, with all of the science fiction stuff that just seems to be, coming into play. So thanks a lot for being here, Nina.
Yeah, thanks for having me on the show today.
Mm-hmm. So let's go ahead and start out by maybe just doing some of these broad themes. And of course, ROBO Global, you have a number of ETFs, and the one that you seem to be most kind of tied to with the research that you do is HTEC. And tell us a little bit about what it is that you're looking for the components to go into HTEC, and what's happening in healthcare in general.
Yeah, so just some background. ROBO Global is a thematic strategy shop. So we're looking at overall robotics, automation, AI, health tech, and our first ever flagship strategy, ticker ROBO, ROBO, includes healthcare. And over the 7 years since its inception, we learned that there was so much happening in healthcare that it warranted its own strategy. Mm-hmm. And what I mean by that is, if you look at the healthcare landscape, there's a lot of problems. Right now, we've got the people over age 85 are expected to double by 2040. Meanwhile, we've got a nursing shortage as it stands, and that's expected to grow. Over half the nurses in the United States right now are over age 50 and likely to retire out of the system. New nurses who come in only practice for a couple of years before they go on to do something else. So we do have an issue here with not enough supply of providers to look after the growing population of people who need the most care.
Growing demand.
We have an issue with medical error already today. It's the third leading cause of death. And so when you factor in that
what do you mean by medical error? Is this problems with the instruments, problems with the diagnoses, problems with the physicians? What is medical error? Why is that so big?
It could come from a lot of places. For example, if you have an incorrect blood draw, something happens to your blood specimen on the way to the lab, and then therefore the resulting the diagnosis could be inaccurate. Over 70% of medical decisions come from lab results. But also, one of the biggest areas is pharmaceutical medication error. So meds are prescribed. Let's say one patient over age 65 has, maybe they're on 12 different meds. They've got different meds from their different physicians that they see. And the status quo is that the doctors aren't talking to one another to coordinate what the patient's on. So you could actually this could lead to hospitalization and even death in some cases. Hence why medical error can be the third leading cause of death in the United States. So, and that problem, imagine what I just said about the aging population and not enough the supply of workforce to look after them. And we already have a problem with medical error. So that problem is probably going to grow. So all of this to say that this whole environment, this confluence of these issues is screaming for disruption and innovation. And it's happening. It's happening rapidly, and we're still in the very early days of it. So there's a long runway here, and we're going to look back in 10 years and be like, wow, and laugh about things like, do you remember when we used to go to the doctor in person for something simple like a sinus infection?
Wait in a waiting room and with a bunch of other sick people.
Remember the waiting room where everyone's sneezing on you?
Yeah. So what are some of the broad themes here? Again, the medical error, I mean, that's huge. But, what are some of the ways, I guess, in which companies are tackling these problems? Again, as you said, there's low supply, high demand, something needs to be done. So what are some of the themes that companies are doing?
And you're right. And there is a lot of things being done, so many that it's really hard to get your head around it. So we think about it in 5 different areas. So basically we're looking at digitization. Healthcare is one of the furthest behind sectors in terms of digitization. It only just went electronic. I mean, medical records charts were on paper up until very recently. Over the last decade, it came from the high-tech stimulus, the $35 billion from the government to invest in electronic health records. So with that, you've got now people's records in a computer versus on paper. You can start to do some really cool things like data analytics and population health management. And then another major theme is decentralization. We're seeing care move to lower cost settings. For example, you might not necessarily need to go to the hospital anymore for surgery. You might be able to go to a tertiary facility and walk out the same day. We saw a huge example of decentralization last year with the accelerated adoption of telemedicine.
Yeah.
More people can see a doctor right from the comfort of their own home or their office. And so that's yet another example of care moving to lower cost settings. A third theme is consumerization. People are shopping more for medical care now, like they did shop for anything else for years. Now that things are being more digitized, we have access to transparency. We can make choices as informed consumers about where we want to get our care. And that's going to drive up quality and force providers and payers to compete for patients' business. And then we've also got two more themes: personalization of medicine. So the one size fits all of medical treatment is slowly starting to wane, and the focus is more on what the individual's illness is, what's their genetic makeup, what's the genetic makeup of the tumor, for example, and then how do we come up with a therapy to treat that exact issue. And so we're seeing a lot more precision medicine, things like gene editing, gene therapy, also like companion diagnostics, where you need a test and then you have a corresponding therapy to treat very specific types of cancer. And then the last theme we think of is the theme of prevention. How do we keep people from getting sick to begin with, and really keep an eye on the population and keep them healthy so that they don't go down the road of becoming sicker and then comprising most of the healthcare's costs.
Yes.
Let's go back to that consumerization, because that was pretty interesting, and that was a little surprising to me with the transparency of prices and things like that. Are prices becoming more transparent there, or is that just kind of that process is just starting because the insurance companies obviously still involved in that? I mean that kind of was a little surprising to me.
Both. So it kind of goes back to the increased adoption of your what is it called when you have to meet your
deductible
benefit? Yes.
Deductible. Yeah.
High deductible health plan. Sorry.
Okay. Yep.
It was that long ago that I forgot what it was called.
Yeah.
The high deductible health plan adoption. So now people went from having to meet $100 out of pocket before health insurance kicks in to now $1,000, $5,000, even $10,000 for some families. And so now that you're basically paying for so much of your own healthcare, you have a right to pick and choose where you get that care. Maybe you don't want to get that multi-$1,000 MRI at the large university medical center. You might want to go to Joe's MRI at the plaza down the street, because now you have to pay for more of it out of pocket. So where is this transparency coming from? It could come from a lot of different places. We're seeing for corporate initiatives, companies like GoodRx are helping to bring the choice of how much you pay for drugs into your pocket. Companies like well, actually all the payers, United Healthcare, are offering their own app where you can often download and then search for an actual exam that you're going to be getting, or a diagnostic test that you're going to be getting, and see what the price of that is, or how much they're willing to reimburse for it. So there are tools that are out there, and there's further companies that help implement some sort of concierge service, so that let's say a patient's trying to figure out where they want to get different treatment or where they want to buy their drugs. You can call a phone number. Companies like Accolade will provide that type of service where you can actually phone them and say, or look at an app on your phone and just say, okay, this is where I should probably get that care, because one, it's in my network, it's going to be covered. two, here's the price of it. Oh, and here's some quality ratings. So, so there's been an increased adoption of that. But I guess my question to you as consumers of healthcare is, how often have you utilized a tool like that? If you're not familiar with where you can find out the price of things and how transparent the level of transparency you have access to, then maybe adoption still has a long runway for growth. And I think that that's the latter, that we have yet to see more and more adoption in terms of pricing transparency.
Well, I feel like even the high deductible health plans, I mean, that's something that I think people are still getting used to. And it's one of those things that you're fine until you get hit with one of those big bills. And then you're like, oh my gosh, and then, maybe you have to let it go that first time because, there's nothing you can do. It's already done. But the next time you start to pause a little bit and, you start to think a little bit about, okay, before I make this decision, is there anything else I can find? And again, the internet just, provides a lot of information, sometimes good, sometimes bad. But I guess with some of these companies helping you out, to a certain degree, or again, insurance companies, maybe even offering some more services. I mean, whether it's
Sure.
the employee, assistance plans, where you can have someone kind of walk you through some of the charges if you have something big coming up, getting that pre-approval. I mean, there's all sorts of things, I feel like.
Optum implemented that.
Right.
They're an early adopter of that, where they guided their employees to utilize a triage service that would help guide where they get whatever care it is that they're seeking. And that will actually help reduce costs in the long run. Let's say you need a prescription refilled and your local doctor office is closed. It's a Saturday, or it's after 10 o'clock at night, or whatever the case may be, you can't get to a doctor. A lot of people's next chance is the emergency room. Well, that's a really expensive visit to get a prescription refilled. So if your health insurance company can guide you appropriately, they're very incentivized to do that, because they'd rather not pay the extra $500 for an ER visit that wasn't really necessary. Yeah. So they're very incentivized to provide these types of tools to guide people and triage them to the right areas of care.
And I definitely want to get back into some of these incentives that are out there for some of these companies that are really kind of shifting, I think, the landscape. So we'll take a break right now. And when we come back, Nina's going to dive into a little bit more of these themes and the companies that are really changing the landscape. Stay tuned.
To help alleviate some of the pain that comes from bear markets, we recommend investing 20 to 25% of the equity portion of your portfolio in a tactical strategy. If you're especially risk-averse, we recommend a higher percentage. In 2008, the market declined 37%, yet our portfolio was only down 12%. Why? Because the conditions for investing were poor, so we held a lot of cash. Visit northcoastam.com/tactical.
All investments involve risk, including loss of some or all of an investment. May not be suitable for all investors. Past results do not guarantee future performance.
Okay, and welcome back to the Investing with IBD podcast, sponsored by North Coast. It's Justin Nielsen here, your host, along with my good friend and almost co-host, but let's say special guest, Arusha Piras, and of course, our real guest, Nina Deka from ROBO Global, senior analyst there. And again, you were throwing a lot of themes out before the break. Let's go ahead and dive a little bit deeper. Why don't we start with the whole prevention? We weren't able to touch on that too much. You mentioned the medical error. So there's certainly some prevention opportunities there. But what other types of preventative medicine themes are out there to kind of help drive these costs down?
Well, I mean, there's a couple of ways to invest in this, really. So if you look at the theme of virtual care, we expect virtual care to underlie every facet of healthcare in the next 10 years. And what does that mean exactly? If you think about somebody with a day job who's pretty much healthy and can go to work every day on their own, come home, keeps himself fed, et cetera, that person's probably not utilizing a lot of healthcare costs and services. And they probably only see a physician for like 6 minutes a year. If that individual is even going to their annual.
If they're on top of it.
Right. If they're even going. Exactly. That's right. So preventative care is really like encouraging that one wellness visit a year. It's for the people who are maybe not starting to see signs of prediabetes, catching that before it escalates all the way to full-blown diabetes. And so really what we're seeing is an increased attention in that primary care setting, because I don't think as a society we've been taking enough advantage of this primary care point. It's like this could be the quarterback of managing all of our healthcare needs. And we really just haven't been leveraging it from a preventative wellness standpoint. Companies like One Medical are very well positioned for that, because they create this nice waiting room with green tea, and you feel like you're sitting on restoration hardware furniture, and it's just a pleasant experience. Teladoc just launched a 360 program where they're looking at patients, consumers holistically, and they're offering everything 360. So from a physical need, mental wellness standpoint, and making sure that they're just keeping an eye on the patient, sending them nudges, reminders, and really just looking after their overall care. So those are a couple of examples. There's an organization called PACE, and this is not necessarily something that you'd invest in from the HTech ETF, but there's a company that sells into PACE. So what do I mean by PACE? Programs for all-inclusive care of the elderly. This is like a nursing home on steroids. And what it does is it provides all of the care for the elderly or people who qualify, and it enables them to live at home in their own home. It'll give them rides to the doctor, rides to the PACE center. They can socialize with their friends there. It'll give them a ride home at the end of the day. Make sure that their meds are included and that they're taking the right meds at the right time. A lot of people don't know this, but people over age 65 are on an average of 12 meds. And the older they get, that number grows. And that can be really tough to manage. Which medicine do I take? What time of day?
Right.
Company called Tabula Rasa, ticker TRHC, offers a pharmacy service and a software platform that will essentially intercept when the doctor prescribes a new medicine, they'll take a look at the patient's overall medication regimen and say, you know what, you're already taking something like that. So why don't you hold off on that particular drug? Or maybe they're taking two drugs that might interact. We mentioned earlier medical error being a leading cause of death. Well, a lot of that will come unintended consequences of prescribing the wrong meds, where two drugs interact, and that could hospitalize a patient. Right. And so if you have a sophisticated software program like Tabula Rasa's, it'll help actually keep people out of the hospital and lower overall medical costs. And the beauty of this for the PACE organization who uses the software is that they'll actually get to increase their profit margin because they're on a capitated system. They get money from Medicare, Medicaid to watch these patients, and whatever they don't spend on the care of the patient, they get to keep. So we're seeing an increase in PACE facilities around the nation. Some are even for-profit facilities because they're finding that, hey, if we can keep these patients healthy, keep them out of the hospital, we can actually improve our bottom line. Yeah. So it's a really cool model, and this company, Tabula Rasa, is very well positioned for the growth.
And so a couple, just to throw out another couple tickers that you mentioned. So One Medical, ONEM. This is one that really kind of came out strong from its IPO. It's been basing for a little bit, which is fairly typical after an IPO, where you kind of go through that institutional due diligence phase. And then what was the other one that you mentioned?
Teladoc.
Teladoc. Of course. Yeah. TDOC, which again, that was one of the big coronavirus beneficiaries. And then of course they had that big acquisition of Livongo. And these were actually some of the stocks that you were talking about, I think, last time you were on the broadcast.
Yeah, and some updates there because these have been kind of controversial. They were Teladoc in particular was on fire last year when people discovered what telemedicine was. We expect virtual care to underlie every facet of healthcare, and the telemedicine visit, the doctor-patient visit, is just the beginning. We're talking about full integration with doctor-to-doctor communication, device to doctor, device to patient, patient to device to device. All these integrations require a high level of sophistication and a platform. And Teladoc is a company that can provide this platform to hospitals, health systems, employers. And so this acquisition of Livongo is just another part of their overall pie of being able to provide this care for the patient from a 360 point of view, whether they're in the hospital or at home managing their diabetes or their weight management. So so they really offer the whole package. And I will say that people thought that telemedicine was just going to be a pandemic trend, but Teladoc's visit volume, the number of doctor-patient visits that they had in the second quarter of this year, grew 28% year over year. Remember, second quarter last year was the height of the lockdown around the world. So the fact that they're already exceeding last year's number in visit volume shows that this theme is here to stay. And then One Medical has been pretty controversial lately because of their acquisition of Iora Health. So I mentioned earlier that you've got a lot of patients, the kind of patient that still has a job, like the before retirement age. So people that are primarily healthy and able to look after themselves, maybe don't have a high instance of chronic illness. That up until recently was One Medical's target audience. Now with the acquisition of Aura Health, they are going further into that over 65 population. Now they're bringing in Medicare, Medicare Advantage, and this is their way to actually focus more of what they can do well, which is keep people healthy, into the population that does consume more of healthcare costs. So I think that when they announced the acquisition, maybe it sent a signal to bears that, okay, they're done growing in the sort of working population. But what I see this is as a massive expansion of their addressable market, and a real great opportunity to leverage their technology, their AI, and their what they do well on a broader scale and make a real impact. So, real exciting things still happening with that company.
Well, so sorry, Nina. Well, one thing here is it could just be really early, right? Yeah. These are the new entrants, because even Tabula Rosa, that's been getting hit too. It just might be so early, and it's kind of like the .com where there's just so many companies, and then they're going to be in the end a few winners, and they're all just trying to position themselves right now, and Wall Street's just trying to figure it out because they're acquiring companies, they're trying to consolidate the fragmented industry.
That's such a good point. And if you look at when any industry is new, you've got a lot of entrants, and a lot of the new healthcare IT and services IPOs have been this new primary care model. There's a lot of companies out there that are trying to be that quarterback of the patient's care. And there's a lot of ways to approach it. You can either approach it from a capitated model standpoint, like PACE, where you get a flat rate to look after a patient and that's it. And or you can approach it where your target audience is employers who have mostly healthy employees, and they charge them a subscription, for example. There's a lot of different models that are out there, and One Medical, to your point about this being early, is expanding because they're like, okay, well, we've got a foothold in this one market. Let's now expand our market to this other area, because you're right, it is early days, and everybody's just trying to get their foothold on as much of the market as they can. And there's a lot of room for everyone right now, because as I mentioned earlier, we do have a lot of problems in healthcare that can be prevented if people did manage their primary care in a way that it was meant to be.
Yeah, and just very quickly here, Nina, where do you see kind of those large cap tech stocks, those big tech players playing in this area too? Because Apple's slowly moving in with their Apple Watch, and Google's obviously doing things.
Amazon for a little while was saying, "Hey, we're going to dabble in this healthcare thing."
right. So obviously there you have them all on the side looking in, because this is just such a huge market. How do you see them interacting with some of these companies? Are they potentially partnering with some of these companies, or are they going to work with some other companies to try to take these companies out?
All of the above. So they are like, you'll see it as a consumer in gadgets like Apple Watch, having more ways to measure your metrics.
Yep.
More data.
And then there's ways that you might not see it as much, where a hospital might be leveraging Amazon Web, or where they're leveraging storage from one of these large tech companies. So there are a lot of ways that they are already working together as partners. Will they be the ones to solve the healthcare problems? Not alone. I think that in order for something to really work for one of the large tech companies, they would look, healthcare is messy. So So maybe let the healthcare first companies lead the way, and then where they need to plug in the gaps, where they need better web services, artificial intelligence, for example, capital investments, maybe that's where it's great to partner. But I absolutely see a place for the big tech companies to start solving some of these unmet needs, but I don't think that they will do it exclusive of the healthcare first companies, if you will.
Okay, so before we finish out this segment, maybe you could talk a little bit about precision medicine and specifically spatial biology, because that's something that I'm sure a lot of members of our audience haven't heard about.
Sure. Spatial biology is really exciting. This is something that people expect to be the next gen sequencing. So what do I mean by that? Right now, when we do analysis and gene sequencing analysis, let's say you have an NGS test, and let's use an analogy of a smoothie.
What was that test?
Next gen sequencing test.
Okay, very good. NGS. Okay.
Let's say you like the analogy I like to use is a smoothie, where you can maybe do an analysis on it and figure out, okay, it's got raspberries and I think strawberries, but we're not sure how many, and there might be some other things in here too. With spatial biology, it's like having a really fancy fruit tray where you know not only that there are raspberries, but they're right here, and the strawberries are right here, and you know exactly how many of them there are. So you get this extra level of detail, granularity that will help further science, because now an example of in today's world is where you have a companion diagnostic, let's say for breast cancer. So you run the test to see if a very specific cancer gene is present in the tumor, and then whether or not the subsequent treatment would be appropriate here.
Right.
In many cases, that treatment might be prescribed, but it still might not work. And the reason why is because there is information missing. There might be some other genetic mutation that treatment is not addressing. So with the bigger, more specific picture of what's happening, you can then give that to work in partnership with a pharmaceutical company and say, okay, let's come up with a slightly different treatment that will address all of these mutations. So super exciting, very early days. One company that's really got an edge in this is Akoya. They're recently public. Another one, NanoString. These are both companies in the H-Tech ETF.
And Akoya, the ticker symbol on that is AKYA.
That's right. And so Akoya is particularly exciting because they've been present in the research world. They're gaining market share, but what they have a nice foothold in is the actual clinical world. What do I mean by that? So right now, a lot of the information that we're getting out of sequencing and all of this new genomic science is happening in the research world, in the academic setting. How do we actually put this information in the hands of an oncologist or use it with pharmaceutical company and actually come up with treatments? And so in order to bridge that, to translate that into the clinical setting, it requires a lot of research, and that's been a big hurdle. But Akoya has actually made headways into the clinical setting, and they're very well positioned for that theme to grow. So as consumers of healthcare, we might have more opportunities in the future to see some of these applications and connect the dots between what we're learning about genomics and how we're actually using it to manage our healthcare.
Great. Well, let's go ahead and take a break right now. And when we get back in the next segment, we'll go over some more stocks that are hitting some of these themes and really kind of looking at a big addressable market that they're potentially going to be serving. So stay tuned for that. We'll be right back.
To help alleviate some of the pain that comes from bear markets, we recommend investing 20 to 25% of the equity portion of your portfolio in a tactical strategy. If you're especially risk-averse, we recommend a higher percentage. In 2008, the market declined 37%, yet our portfolio was only down 12%. Why? Because the conditions for investing were poor, so we held a lot of cash. Visit northcoastam.com/tactical.
All investments involve risk, including loss of some or all of an investment. May not be suitable for all investors. Past results do not guarantee future performance.
Welcome back to Investing with IBD podcast, sponsored by North Coast. It's Justin Nielsen here, your host, along with Arusha Piras and our guest, Nina Deka from ROBO Global, a senior analyst there. And she's been talking to us a lot about these healthcare themes. Let's talk a little bit more about some of the stocks that are setting up and taking advantage of these. Now, one thing I should start out and say, a lot of the charts that we've been pulling up, the charts don't look that great, right? These are stocks that have been kind of out of favor for a little while. A lot of these don't have earnings. Now you do see the sales ramping up. So just kind of put an overall, picture on this for a lot of these healthcare names, Nina. Are these companies that are doing a lot of investment still, or is it something that investors aren't seeing the potential quite yet? What's your take on it?
Well, I think in general, with the correction that you guys discussed earlier, and then pressures around government bonds and yields increasing, treasury yields on the rise, you'll often see tech stocks take a hit. And so H-Tech is all tech stocks. It's healthcare tech. And so it's going to get a little extra hit. And if anything, in my view, that's an opportunity for some great entry points across all of these themes. I mentioned earlier that we kind of bisect or dissect these into 5 different investable themes. The way that we look at it at Robo is we break down and say, okay, what are the real areas where we see the most disruption happening over the next 5-10 years in healthcare? And we wind up with like 9 different subsectors, including telehealth, as I mentioned earlier, genomics, as I mentioned earlier, another cool subsector we call process automation. And this is one where companies will partner with some other company kind of behind the scenes to help them manufacture or get their products to market. And so we believe in this diversification because we think it really offers an investor the ability to capture what's happening in the different areas when the time is hot. Maybe telehealth has taken a back seat this year, but last year it was on fire. Maybe precision medicine is the place to be right now. Biotech, while some of these other areas are taking a back seat. But process automation is where it's at right now. And so if you have a diversified portfolio, you can gain access to companies like Catalin, for example.
Well, let's go ahead and start there. Now, Catalin, this is one where it's been on a lot of our screens because this is one that has had earnings. It has had some strong revenue growth, and it's been getting rewarded by the market. Now, this, in a way, is a little bit of a COVID play. How so?
A little bit, but there's so much more than that. So let's start with what they do. So let's say about an estimated 1/3 or a little bit more than 1/3 of drug manufacturing is outsourced. A lot of these pharma companies and biotech companies can't do everything on their own. Imagine all of these biotech startups. They just raised capital. They just went public. They don't have the factory. And if they're working on an orphan drug, maybe their clinical trial only has 4 patients. How do you manufacture that at scale for a clinical trial just to even bring a drug like that to market? So a lot of these companies have to partner with a manufacturing organization, CDMO, contract development manufacturing organization. Catalin falls into that bucket. In the last 5 years, Catalin went all in investing on being that partner that can help these companies develop these very unique specialized drugs. And one of the people that they partnered with, one of the companies they partnered with was Moderna. So they had an edge on mRNA and really were able to step up to the plate when Moderna had to manufacture the COVID vaccine at scale. And now, as a result, Catalin has the manufacturing expertise and knows how to bring mRNA therapies across the finish line. That bodes very well for a brand new part of the industry. So as more companies decide that they want to manufacture or even develop mRNA treatments, Catalin's sitting in a very sweet spot for that. They also partner with J&J and help manufacture that COVID vaccine, which is based on a different therapeutic modality. Catalin has invested heavily in their ability to manufacture viral vector therapies. So they really went niche, and they're like, we're going to do this tiny thing that's expensive and hard to do, and we're going to do it really well. And they're seeing results. They recently raised their long-term revenue growth rate by a couple 100 basis points. Stock moved on that. They also saw year-over-year growth in what they're calling their biologics division. That's the division that I just described as all this cool high-tech stuff. That grew like 66% year over year. And what a lot of people don't know about Catalin is they invented the soft gel.
Yeah, I was
They've
I
been
was so
around for a
amazed
long time.
when you said that. I looked into it and I'm like, holy cow, and that was a long time ago.
Yeah.
Very
So there's a lot
interesting.
of companies behind the scenes. Lonza is another example
Mm-hmm.
that a lot of these innovative companies work with in order to get their drugs to market.
And what's interesting is it's really, it doesn't matter who the winner is. A lot of them, it's a good chance that the winner is going to be using Catalin. So they win no matter if it's Moderna or whoever that kind of comes to market first with some of this stuff. They're behind the scenes getting the business no matter what.
They're the picks and shovels play, right?
Absolutely.
They fall in that category.
Yeah, and they're kind of like a lower risk way to get exposure to a lot of this innovation. Like Catalin gets paid for helping a company with their clinical trial. If that drug never comes to market, if it fails,
right.
Catalin still did the business. They still provided a service. If it does make it to market, they get to be a long-term partner potentially for the life of that drug. Keep in mind that when a company files for FDA approval, they have to submit a form that says, here's how we're going to manufacture this drug for the trial and eventually when it comes to market. So Catalin or companies like Catalin have already been factored into the recipe. They're locked in for
early
a
partners.
amount of time. And then decades later, when the drugs fall off patent, guess who still holds the ability to manufacture this thing at scale? And so as generics come into play, they might ring Catalin's phone number and say, hey, we understand you know how to make this well.
You've already got this process down. Can you do it for us?
Exactly. Yeah. And there's other companies that are like that too. Thermo Fisher Scientific owns the largest CDMO through their acquisition of Patheon.
And that's TMO is the ticker symbol on that.
That's another company in the HTech ETF as well.
Yeah. So let's maybe turn our attention to another stock. This is one that we've been talking about a little bit more recently, had a nice move previously, then took a break. Dexcom. Now this is in the diabetes, and we do have a lot of these situations where you've got these chronic diseases that require another level of monitoring, and you don't want to mess this stuff up. So what is it that Dexcom is doing, and is there something that they're doing differently now than they were before?
So Dexcom is very interesting because they sell a continuous glucose monitor, CGM device, and it's pretty well known for its level of accuracy, and it's also very small. And what they've been working on for a while is the next generation of it. They're already on their 6th generation, the G6, and they're working on the launch of the G7. They just announced that they filed for CE mark approval so that they can market this in Europe, and they expect to launch it in Europe by the end of this year. And they just finished their trial in the US, and they're looking to file soon for the US, and we don't know exactly when that'll be launching in the United States, the G7, but the G6 is fine. People love it. They've gained a lot of market share. Like I said, it's accurate, it's easy to use, it's very small. Actually, the G7 will be even smaller, it'll be the size of a nickel. And and so one of the things that they're doing is they're going after a broader market. So when we think of continuous glucose monitoring, we're thinking of people with type 1 diabetes who say have to do a finger stick like 8 times a day. And that requires reminders, alerts. And if you have it where it's continuously being monitored, then you save yourself from having to stick yourself with a needle and check it on your own. The user doesn't have to do anything anymore. They just get to wear this device. What's new is that this technology is now increasingly being deployed into type 2 patients. So not just people who are insulin dependent, for example, but people who got diabetes later in life. And that is a much bigger addressable market. So, and even pre-diabetes, this is something that a doctor might want to recommend to a patient to keep an eye on their glucose. So the market keeps growing, and the use cases and the potential for the use cases is also growing. Dexcom is also integrated with the insulin pump manufacturers like Tandem and with Insulet. And so, so having that integration, they're also a partner of Livongo. I mentioned them earlier. This is a company that was acquired by Teladoc. So you can use the CGM device to also have that coach in your pocket that can call you and nudge you if you need to drink a glass of orange juice. So their integration is large. Their ability to sell into the pharmacy setting is also going to help them gain traction. And these CGM devices were also, they were kind of game changing last year in the inpatient setting. We think of monitoring your glucose as something you do at home, which it is. But during COVID, we found that the people with diabetes were at higher risk of severe complications with COVID-19. And yet now you're potentially in a coma or in an isolation room or very sick, and it's very hard to track your glucose. So companies like Abbott and Dexcom were able to provide these CGM devices into the inpatient setting, which weren't traditionally used there in the past. And now it enabled the providers to monitor the patients, the glucose, and keep them healthy and alive.
So Nina, so they have an app that you can just have on the phone for the continuous monitoring?
Yeah, and that can all be integrated wirelessly. And
Wow.
this goes back to what I was talking about with like connectivity and virtual care.
And it notifies maybe the doctor or something like that. That's what you're...
Exactly.
Okay,
exactly.
That's very interesting.
And yeah, and this is
gives that doctor data. There's probably a continuous readout of, okay, here's how it fluctuated.
And alerts can be set up in order to notify somebody if something goes out of range. You can track over a longer period of time to see how the patient's doing, if something needs to be modified. But this goes back to what I was saying earlier about how we see the doctor face to face for a couple minutes a year, but then we're left to our own devices to manage our own care. And so something like this, to your point, connected to the internet, can give the doctor information about what you're doing.
And I do want to make clear that I also own shares of Dexcom. It has been working quite well, especially over the last couple of months, and so it started coming back up on my radar.
Very good. Let's go ahead and end with another stock. FATE is the ticker symbol on this one. And what is it that this company does, Nina?
So this is another interesting therapeutic company. They don't have a drug on the market yet, but they are progressing through clinical trials. They're working on a different therapeutic modality known as natural killer cells. NK is the abbreviation of it. And this is where you can take like a stem cell one time and then replicate it and make many copies of it, and then essentially make the drug in a lab, if you will, and then use that for a very long period of time with wherever and however you need to use it. This compares to another therapeutic modality known as CAR-T, where in order to use that therapy, you actually have to take cells out of the patient and then ship it off, have the drug manufactured, ship it back, and then administer it into the patient. So it's the patient's sample that's then making the drug. Whereas with natural killer cells, it's cells that exist, they're off the shelf, and then you can use them in any way that's needed. What's interesting about natural killer, also compared to CAR-T, is that process of CAR-T where you have to take the cells, ship it off, manufacture. It's more difficult to scale, and that whole treatment regimen could cost $250,000, give or take, over $100,000 at least. Whereas with natural killer, you can make you manufacture this drug in about $2,000. So wow. It costs a lot less to make. It's available off the shelf. Well, it's not available yet, but that's the goal. And then it's potentially could be safer. It could lead to lower toxicity. Not to say there's anything wrong with CAR-T. CAR-T is great. It's saving lives. It's showing durability. So Fate could just be yet another option. And it does have potential to be a better option in some circumstances where we invest in both CAR-T stocks as well as Fate for this natural killer. And so it's really exciting with the lower potential for lower toxicity. Data that the investor community is waiting on, some next catalyst would be to find out if Fate does have the similar durability as CAR-T. And so the passage of time will help tell whether or not the patients that have been treating with it were able to keep their cancer levels lower.
Well, speaking of potential and expectations, this is a stock that in the last 5 years has gone from about $1.50 to over $100. So there definitely are some expectations, and going with this. And as you compare with the prices, $250,000 or around there to $2,000 and just kind of off the shelf. Yeah, I mean, this idea and this therapy has that huge potential.
And are there competitors here? Are there other people doing this, or is this kind of like at the cutting edge of it?
There's more than a handful of companies going after this space. So it's definitely something that's exciting, and Fate's not the only one. But I believe Fate's a technology leader in this particular part of the market. So they're several years ahead of other companies that are also going after NK.
Mm-hmm. And it looks like there are a couple of IBD mutual funds already invested in it, Columbia and T. Rowe Price.
Yeah, two that we follow very closely. So, and again, with a technology called Natural Killer, that's probably pretty appropriate for a Halloween month coming up. So now, Nina, you write a blog. You sent me your blog on Catalin, which was again really interesting. Where can people find more information? Because again, there's a lot that you have to cover, a lot of themes that you're keeping track of. Where's a good place for people to find information?
RoboGlobalETFs.com is a great place to go to learn more about the ETF.
Mm-hmm. And then again, you have some blogs that are available there, which again are just absolutely fascinating. Some really great work. And as you mentioned at the outset, an opportunity that's huge given how much inefficiencies there are in healthcare, how much the costs are, and just ripe for disruption.
That's right. Yeah, it's really early days. There's a lot of room for growth. We're just starting to see what's going to be transformed over the next decade, and it's a really exciting time to be involved with healthcare innovation.
Okay, and of course, that ETF that you are most intimate with is HTEC from ROBO Global, so people can check that out and kind of keep an eye on the stocks that you are following. So thank you so much.
80 or so companies in it, so people who are like, I don't know where to start. There's so much cool things happening in healthcare. I don't know which one stock to buy. Single stock picking can be really tricky if you're not a healthcare expert. Yeah. You can buy a basket of them and have exposure to these different areas.
Well, and as you mentioned, there's also different things coming into favor at different times. And so you can kind of be still participating even when things are falling out of favor temporarily, possibly.
That's right.
Mm-hmm. Well, again, thank you so much for joining us again, Nina. It was great having you.
Thanks so much for having me.
And on next week's show, oh my gosh, Arusha, we've got Scott St. Clair coming to the show. He's senior, what is it? Senior product coach and manager now. I guess just the manager title applies. Yeah. Just manager. He's no longer senior anything. But Scott, of course, you guys just had a really great webinar on MarketSmith from Napa Valley, which was quite enjoyable to watch. So a great friend of the show. We're excited to have Scott St. Clair back. So make sure you tune into that next week. Thanks for watching us this week, and we'll see you next time. Bye-bye now.
And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.